Alright, quick check before we dive in. If you've been watching silver and thinking this move feels different, you're not imagining it. Something just shifted, and it happened fast. In the last stretch of trading, silver didn't just creep higher, it snapped. It grabbed attention. And the real trigger isn't speculation, it's policy. Specifically, a sudden escalation. A 25% US tariff on South Korea, announced by Trump, right as markets were leaning toward stability. Stay with me, because I'm going to show you why silver is flashing a red alert right now, how this mechanism actually works, and how you can spot this pattern before the crowd catches on next time. If you're watching this now, you're already ahead of most people who won't see this until it's priced in. Your job is to understand what's driving this, not just react to the price. Before I explain what caused this move, let me teach you something most people never really internalize about silver. You probably hear precious metal and think safe haven, like gold's quieter cousin. But silver's different. Silver lives a double life. It's money when confidence cracks, and it's infrastructure when the global machine is running. Think of it like a bridge cable that also happens to be a life raft. When trade flows smoothly, industry pulls on silver. When trust breaks, fear pulls on silver. And when both pull at the same time, price doesn't walk, it jumps. That's what you need to understand before reacting to any headline. So what does that tell us? It tells us that silver doesn't move like other assets. It's not purely safe haven. It's not purely industrial. It's the intersection. And when pressure comes from both directions at once, you get these explosive moves that seem to come out of nowhere. But they don't come from nowhere. They come from understanding silver's dual nature. If this is making sense, drop a comment below and let me know if you've been tracking silver lately. Now here's what's actually happening. Let me break down the sequence, because this isn't random. The tariff announcement hits. Immediately, you've got higher input costs for sectors tied deeply into South Korean supply chains. We're talking autos, pharmaceuticals, advanced manufacturing. That's the primary driver right there. Costs go up, margins compress, production slows or shifts. Companies don't just absorb a 25% tariff overnight. They pass it through, they delay orders, they look for alternatives. And South Korea isn't some minor player. They're critical in electronics components, battery technology, semiconductor equipment. When you slap a 25% tariff on that supply chain, you're not tweaking the system, you're shocking it. Now the secondary effect kicks in, and this is where it gets interesting. Investors don't just price higher costs, they price uncertainty. If tariffs can jump to 25% overnight with basically no warning, what's next? More countries? More retaliation? Europe responding? China escalating? That's where confidence in the global trade system starts leaking out. And when confidence leaks, capital looks for something that doesn't depend on smooth cooperation. It looks for assets that hold value even when the system's grinding. Silver is one of those assets. So here's the convergence, and this is critical. Industrial users still need silver. They need it for electronics, for energy systems, for medical equipment, for solar panels. Demand doesn't disappear just because tariffs went up. If anything, certain sectors might stockpile ahead of more disruptions. At the same time, investors start treating silver like insurance against policy chaos. Two demand streams converge on a market that already isn't flush with excess supply. Silver inventories have been tight. Production hasn't kept pace with industrial demand growth. Now you're adding speculative demand on top of structural demand. That's why silver reacts so violently in these moments. But here's the part that should make you nervous if you're ignoring it. This isn't a one-day story. This is a regime signal, a shift from cooperative trade to leverage-based trade. When policy becomes a weapon, when tariffs become negotiating tools instead of stable frameworks, silver historically doesn't wait for permission to reprice. It moves first. And I want you to understand why. Because in a world where trade rules are stable and predictable, markets price efficiency. But in a world where rules change overnight, markets price risk. And silver is how institutional players hedge that risk without going all the way to gold. It's more volatile, it's more leveraged to industrial disruption, and it's more responsive to sudden shifts. This is the exact same playbook we've seen before. Every time trade tensions move from negotiation to punishment, silver wakes up. Let me give you some context. In 2018, when the first wave of China tariffs hit under Trump's first term, what happened? Silver had been sleeping in the mid-teens for months. Within weeks of tariff escalation, it started climbing. Not because traders got excited, it moved because the system got stressed. Industrial buyers started hedging input costs. Investment funds started rotating into hard assets. Same pattern. In 2011, during the European debt crisis, when trust in global financial coordination was fracturing, silver didn't just rise. It spiked to nearly $50 before correcting. Why? Because uncertainty about currency stability and trade flows drove both industrial hedging and safe haven demand. Every time you see this dual pressure, you see silver respond disproportionately. Go back even further. In the early 2000s, when China joined the WTO and global trade was expanding rapidly, silver moved higher because industrial demand surged. But then in 2008, when that system broke, silver initially crashed with everything else, then roared back as investors realized the monetary system itself was being questioned. Same asset, different pressures, but the pattern holds. When you zoom out, you see the larger story. Silver responds to moments when the economic engine starts coughing, and everyone realizes the rulebook might change mid-game. That's when silver stops behaving like a sleepy metal and starts acting like a signal flare. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this fade? Of course. Markets overreact sometimes. Headlines get walked back. Tariffs get delayed or negotiated down. And yes, there are always voices saying silver's manipulated or purely speculative noise. Let me be honest with you. Short-term moves can be noisy. Traders take profits. Algorithms trigger stop losses. Volatility creates whipsaws. But here's the thing. The mistake is dismissing a structural trigger just because price has moved before or because short-term action gets choppy. Focus on what you can control. Watch policy language. Watch supply chain data. Watch confidence indicators in currency markets and bond yields. When those align, price tends to follow, not the other way around. You can't control whether this tariff gets modified next week, but you can track whether the underlying tensions are escalating or de-escalating. There are probably 3 types of people watching this right now. The first is already in silver, either physical or positions, and you're feeling validated but unsure what to do next. If that's you, don't confuse confirmation with complacency. Just because you were right about the direction doesn't mean you're done managing risk. Track the macro signals, not just the price. Watch for follow-through in policy. Watch whether other countries get added to the tariff list. Watch whether South Korea retaliates or negotiates. Your edge right now is patience and risk management, not victory laps. The second type is skeptical. You're thinking this feels overhyped, maybe even manufactured. You've seen silver spike before and fade. That's a healthy perspective. Your edge is patience too, but different patience. You're waiting for follow-through in policy language and trade responses before acting. That's smart. Don't let FOMO push you into a position you don't understand. But also don't dismiss the signal just because you've been burned before or because the narrative sounds too clean. Test it. Track the data yourself. See if industrial demand holds. See if investor inflows continue. Make your decision based on evidence, not skepticism alone. The third type is new. You're wondering if you already missed it. You're seeing headlines about silver moving and feeling like you're late. Let me tell you this. Missing the first move isn't missing the trend. Trends driven by fundamentals don't resolve in a day. If this is truly a regime shift in trade policy, if we're moving from stable cooperation to leverage-based negotiation, silver's reprice will take months, not hours. You're not late to a trade. You're early to understanding a structural shift. For all of you, the universal principle is the same. Don't chase emotion. Track structure. The price will do what it does. Your job is to understand whether the underlying conditions support continuation or reversal. So here's what I want you to answer in the comments. Which type are you? Are you already positioned, waiting skeptically, or just starting to pay attention? And what's your biggest question about this move? Because the more we discuss this as a community, the sharper we all get at spotting these patterns. Here's where I stand. I'm not pounding the table screaming apocalypse. I'm not saying silver's going to double tomorrow. But I'm also not shrugging this off as noise. I'm watching 3 things closely. First, I'm watching whether tariff rhetoric spreads beyond South Korea. If we start seeing similar language toward other key trading partners, that changes the game. It signals this isn't tactical negotiation, it's strategic repositioning. Second, I'm watching how industrial demand data for silver holds up as input costs rise. If manufacturers start cutting production because costs are too high, industrial demand could soften. But if they stockpile or absorb costs, demand stays firm. Third, I'm monitoring currency markets and especially how the dollar reacts, because that's where confidence shows cracks first. If the dollar stays strong, it could cap silver's upside. If the dollar weakens on policy uncertainty, silver gets a tailwind from both directions. Based on my analysis, this move in silver wasn't emotional. It was mechanical. The fundamentals aren't breaking, they're validating. Industrial demand is structurally tight. Supply hasn't expanded meaningfully. And now you're layering on policy risk that acts as an accelerant. The fundamental picture hasn't changed for the worse. It's changed for the more uncertain. And uncertainty, when combined with tight fundamentals, tends to push prices higher, not lower. If history rhymes and silver continues to track policy escalation the way it has in past cycles, the move that follows could be significantly larger than what we've seen so far. This red alert is less about a spike and more about a reprice. Now, I'm not a financial advisor. This is not financial advice. I'm a market observer sharing analysis and pattern recognition. You need to do your own research. You need to verify everything I've said. You need to make decisions based on your own risk tolerance and situation. But if you made it this far, you're the type of person who thinks critically and wants to understand the mechanics, not just react to headlines. That mentality will serve you well whether you're trading silver, watching markets, or just trying to make sense of what's happening in the global economy. If this breakdown helped you see the pattern more clearly, do me a favor. Share this video with someone who's trying to understand what's driving markets right now. Hit subscribe if you want more analysis that cuts through the noise and focuses on structure. And stay ahead of the crowd by learning to spot these signals before they become headlines. Think critically, verify the data, and make your own decisions. Stay sharp out there.